Hi there, I'm Edward Kalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're taking a closer look at Boeing. Once a symbol of American industrial dominance, now a company fighting to survive reputational collapse, financial strain, and deep operational dysfunction. From the 737 MAX disasters to production halts, quality control failures, and mounting debt, Boeing's last 5 years have been nothing short of brutal. But with commercial aviation demand still strong and defense contracts flowing, the big question is Boeing finally turning the corner, or is it still a value trap in disguise? Let's run it through our 5 key factors. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's get into it. Let's start with one of the strongest indicators of a great business: consistently high returns on capital. To be direct, Boeing's numbers are still grim. Return on invested capital sits at minus 9.7%. And return on equity is not meaningful, as total equity is negative at minus $3.3 billion. These metrics reflect the damage from the 737 MAX crisis, pandemic-era disruptions, and persistent manufacturing setbacks. Boeing is still destroying shareholder value on paper. Unless Boeing can return to consistent profitability, these numbers won't recover. And right now, that recovery is far from guaranteed. Next up, is Boeing showing strong and sustainable growth, or has it struggled to regain momentum after recent setbacks? Over the last decade, revenue declined with a compounded annual growth rate of minus 4%. Net loss totaled a staggering $11.8 billion, and Boeing showed a loss of $18.4 per share. Yes, Boeing still has a massive backlog of 5,600 aircraft worth over $400 billion. And yes, commercial travel is rebounding globally, but ongoing FAA scrutiny, missed delivery targets, and supplier bottlenecks, especially with Spirit Aerosystems, are preventing Boeing from translating that demand into revenue. On the defense side, programs like the KC-46 tanker and MQ-25 drone are active, but these aren't enough to offset commercial losses. No earnings per share growth means no compounding. We're still in the red, not the recovery phase. Let's see if Boeing's financials are solid enough to back its future. This is where Boeing's challenges are most visible. Cash and short-term investments sit at $26.3 billion and total debt at $56 billion. With a negative equity of $3.3 billion, the debt-to-equity ratio is not usable. And here's the real concern. Free cash flow for fiscal year ending 2024 was negative $14.3 billion. That's not just bad, it means Boeing is burning cash while already carrying a massive debt load, with limited room to maneuver. Cash on hand is decent, but the negative free cash flow is a red flag. Boeing will likely need to issue more debt, delay stock buybacks, or even dilute equity if this trend continues. Now let's take a closer look at Boeing's valuation. You'd think a stock in this condition would trade at a discount, but Boeing still carries a surprising premium relative to its fundamentals. With a PE ratio of minus 13.7, that's not meaningful because it's still unprofitable. By contrast, Lockheed Martin trades at 23.7, Airbus at 32.7. In addition, Boeing's free cash flow yield is negative. Investors aren't buying Boeing for today's cash flows. They're betting on a 2 to 3 year turnaround and a return to scale. That's a tough ask given the operational risk. Boeing is not just richly valued, it's unanchored from near-term fundamentals. The valuation reflects hope, not results. Does Boeing still have a strong, lasting competitive edge? Yes, but it's no longer bulletproof. Boeing still shares a global duopoly with Airbus in large-scale commercial aircraft. It maintains long-term US defense and NASA contracts. Its IP and technical know-how are deep and hard to replicate. But the moat is under siege from within. Airline CEOs and regulators have publicly criticized Boeing's culture and safety practices. FAA oversight is tightened, and quality control failures have made customers question reliability. The moat still exists, but it's being undermined by internal dysfunction. If Boeing can fix its execution, the moat regains power. If not, the moat narrows with every failure. Before we wrap up, the detailed charts in this video were powered by Fiscal, my go-to investment research platform. Use my affiliate link for 15% off to level up your stock research at no extra cost to you. Is Boeing still a blue chip giant or a sinking ship hiding behind its brand? With return on invested capital at minus 9.7% and negative equity, Boeing is destroying shareholder value. Revenues declined 4% annually over the last decade, ending 2024 with a loss per share of $18.4. $26 billion in cash is solid, but negative $14.3 billion free cash flow and $56 billion total debt signal stress. The valuation is still expensive for a company bleeding cash and profits. The moat is still real, but weakened by trust and execution failures. Boeing is a classic turnaround play, but the turnaround hasn't started yet. The upside is massive if execution improves. But based on the latest numbers, this remains a high-risk bet on one of America's most iconic companies getting its house in order. What's your take? Are you still bullish on Boeing, or is the damage too deep? Drop a comment, hit like and subscribe, and let me know which stock you want to see next. Thanks for watching, and I'll see you in the next one.